All right, welcome and thank you for joining HCM's special after the election town hall call with Doug Johnson and Mike Hanghold. Today is November 4th. This call will last about 30 minutes, and during that time, Doug and Mike will discuss the possible election outcomes and the possible market outcomes based on those scenarios. Your lines are muted, and we ask that you please keep them muted. If you have any questions during the call, please send them into our email box at info@hcmwealthadvisors.com. I will now turn this over to Mike and Doug. Mike?
All righty. Thanks, Maureen. Welcome, everybody. Welcome to our What in the World Just Happened conversation. I'm here today with, this is Mike Hanghold, obviously. I'm here today with Doug Johnson. He's a partner, one of my partners here at HCM Wealth and the director of our investment group. So we're not going to spend a lot of time rehashing things that are being covered in the news and so forth. There's plenty of sources for that type of information. What we really wanted to do was talk about the most current observations that we have based on what we think we know now and how that may shape the way we think about the portfolios and our planning here at year end, and how that may have clarified some things we have been wondering about or questioning over the last couple of weeks as we start to zero in on December 31st. What we obviously think we know now, that this is information that's available to everybody. What we think we know now is that the Senate will remain in Republican control. And what that means is there was a long list of asymmetric unknowns that we were concerned about had we experienced what people are referring to as the blue wave. So if the Democratic Party had taken control of the House, the Senate, and the presidency, there was the potential for some pretty significant changes in tax policy and other matters regarding stimulus and governance and so forth. With the Senate remaining in Republican hands, that seems to have been taken off the table. Based on today's market reaction, the sort of typical thought process that the markets like to see government with their hands tied because they like predictability and they don't like uncertainty seems to be playing out. So that's sort of the foundation. If Vice President Biden is elected, it will obviously be difficult for him to change things through legislation. However, interpreting regulations through the appointment of department heads and executive orders, things like that, is shown to be a fairly effective strategy. So we're not suggesting that we think all of these what we sort of refer to as the asymmetric risks are taken off the table. Certainly some of the big ones regarding tax policy and so forth are, but there's still a lot to come and a lot to be interpreted. So, Doug, with no further ado, as a result of what we know so far, how are you thinking about our approach to the markets?
Well, I think the reaction that we're seeing today, I don't know that I'd call it surprising, but I think it's trying to tell us that, of the scenarios that we had laid out, I believe on the webinar, and I'll go through the one that I'm referring to, the Biden presidency, Republican Senate, as you said, kind of ties things up, so to speak, and it really may put us in the same type of environment that we've seen over the past 5 years. Now, what does that look like? So before this election, many polls were predicting this idea of a blue wave. So blue wave being, Democratic control of the Senate, Democratic president, You'd have this massive amount of stimulus come through, and this idea that you'd have a reflation trade coming through. So some of these asset classes that have been beat up, particularly on the value side, would start to see a little bit of life. Well, today you're seeing life, but you're seeing it in a different way, because if that stimulus kind of unchecked is off the table, now you're reverting back to an environment where you've got a little bit of gridlock, and the economic growth outlook going forward is somewhat uncertain. So the NASDAQ is up quite a bit today on the belief that investors are going to be willing to pay up for companies that can grow their earnings in almost any type of environment. And we've seen that type of trade take place over the past 6 months, but we could now be in an environment where we see a continuation of that. So there's certainly value assets that are very cheap across the board. In some places, very, very cheap. But I think as we go forward, the timelines for those themes to possibly play themselves out might have extended a little bit. On the fixed income side, we've talked a lot about the possibility for inflation going forward. I think those inflation forecasts will come down, and the threat of having your fixed income assets becoming a negative return on your portfolio has diminished a little bit, but there's still work to be done there, because if it's going to be a lower for longer environment, does it make a whole lot of sense to hold a lot of treasury bonds that they're yielding 75 basis points? If you're in a deflationary,
one of the things that we've been discussing in our investment committee meetings with the other members there has to do with the struggle with fixed income, and because there's a lot of duration risk in fixed income portfolios, not much in the way of return, and how we might look to other areas. I know one of our favorite themes, obviously for 20 years, has been dividend-paying stocks, dividend growth stocks, maybe I should say a little more clearly. And one of the things that's come up recently in the meeting that ties together what you were just saying. Some of these value sectors, for example, energy is one. The yields are astronomical, really, by comparison. And so one of the questions is, are they safe? Obviously, the time horizon for investing in something like that would have to be longer, because we'd have to get through this current period and get back into that period where the sort of cyclical and so forth sectors were doing well. But in that notion of buying when blood is in the streets, is it time for something like that?
Yeah, I think it makes sense to start to look at some of these asset classes. I mean, you mentioned energy. There's still a strong possibility that there's dividend cuts still to come in the energy space. But even if you're cutting a dividend by 50% that is yielding 10 and it goes to 5, that's still a pretty hefty number. And on top of that, a lot of these energy assets are trading at historical lows. Almost like the entire industry is going to go out of business overnight. So, would I throw a ton of money at these? Probably not. But would I, try to be a little bit opportunistic and be willing to take some risks in certain areas where I think valuations have maybe gotten a little too beat up? Yeah, absolutely. I think there's certainly places to look. And I know, with the dividend growth portfolio, we have a few of those names in there right now.
Okay. Do you see other market implications based on the things that we know now? I mean, in our last call, we had talked about a sort of a variety of scenarios. Now, that list of sort of potential combinations is getting much narrower. How do you think about that?
Yeah, I mean, I think we're starting to get a clearer view, and as I mentioned before, this idea of a kind of a checked stimulus environment or an environment where neither party is really going to be implementing, quote unquote, their plan, I think you're going to hopefully get a little stability in terms of that response. And then in that environment, I think, like I said earlier, it'll probably be a continuation of the environment that we've seen, where the Fed will still remain active in providing liquidity to the markets. You're going to get some stimulus, and then I think the wild card in all this remains what's going to happen with the COVID situation. We've seen cases kind of exploding globally. You've had countries in Europe now going back to 30-day lockdowns, maybe not as extreme as they were before, but lockdowns nonetheless. So even outside of all this election rhetoric and what might happen, we still have that kind of big dark cloud hanging over our heads, and what I'm curious to see what the willingness from both sides will be going forward to add additional stimulus, at least in the amounts that they were talking about earlier. Will it be will the number will it be a T or a B? Will trillion or billion? And how is the market going to react to that? Almost in an environment where stimulus has become expected. And I'm curious to see what that will look like.
And how it, so let's give it the T or the B. I know some of the things we've been focused on is the amount of stimulus and where it goes. One of the things that would certainly be important in the negotiations, we know from the campaigns, is where that money would likely be directed. We talked about the energy sectors. The Democratic Party highly focused on, alternative energy solutions, the Green New Deal type discussions, whereas President Trump on the trail makes a big deal over continuing fracking. So there's a pretty wide divide. How does that level into our thinking?
Well, I think if we do see a stimulus deal, that's very much COVID related, I think the main focus should be getting the money into consumers' hands, because they're the ones who are going to be without jobs or really struggling. I think any stimulus deal outside of a COVID world, you might start looking at things like infrastructure or green energy, more, I don't want to call them pet projects, but more of those things that the two sides have been talking about forever, that they just haven't got around to yet. But I think, what the market has been telling us for the past 6 months is, almost any level of stimulus is going to be supportive of risk assets. It may not be equal across the board, but it's been enough to, I'd say, overcome some very, very lofty valuations. And as we've kind of moved into this new realm where there's an expectation for stimulus, I think that any level of stimulus would be important and go a long way into at minimum supporting asset prices, and at best continuing to drive them higher. So
then, pulling together what what I'll say we think we know at this point is there was a risk that corporate taxes were going to go up by about 33% from 21 to 28. That's likely not going to happen. There was a risk for high earners to see their income tax rates going up. There was a risk for high earners to see their capital gains tax double from about 20% to 40%. There was a risk for in the estate planning realm of the exclusions going from roughly $20 million to where many Democratic strategists had hoped to get back to $3.5 million, if not to the targets for a couple of years from now of $5 million. So a lot of these things were driving people potentially waiting for today. We know we have a lot of clients stacked up with documents drafted at their attorneys and so forth in order to execute if it appeared there was the potential for these changes that could have been retroactive to the first of the year. To me, on the planning side, that's a big deal to have that off the table, because it provides the plus side here is that it's motivated people to think about some things that people naturally want to put off. But at the same time, having sort of started that thought process, we're not under the gun to make really rash decisions. And as I was walking through those things, most of the things I led with high-income earner here, high-income earner there. Anybody that's followed, the campaigns and understands the tax policy implications. $400,000 of income was a big deal for Democratic policy changes. And on the capital gains side, it was going to be $1 million to pay that twice the normal capital gains rate. But remember that even though that may be the 1% crowd, they control the vast majority of the wealth. And so had those decisions come to the point where we had the blue wave, there could very realistically, have been a lot of very active selling simply to trigger gains in this year, which could have driven prices lower. The last piece of this is put off the table that would have affected everybody who actually inherits anything was the change in basis rules. So anybody who has inherited assets from family members knows that the tax liabilities that existed in the hands of the decedent basically get wiped away, and the recipient gets to start fresh. That was one of the privileges that the Democratic policy wanted to wipe away. So all those had the implications for security decisions and investment decisions, as well as planning implications at the end of the year. People are tuning in here to kind of hear some maybe a little more specific, and obviously we can't say, we don't even know who the president's going to be, or that with absolute certainty where the Senate's going to settle. But as we look forward, what are the specific things in terms of policy? Are we looking strictly for opportunities to increase equities? Are we looking to reposition our fixed income portfolios for better yield since we've got this lower for longer mentality? How does that all come together sort of specifically from a vision perspective, realizing with the disclaimer that all this could change?
Yeah, so I think as things stand now, I think that a lot of people kind of have feared a worst case scenario, and ironically, everyone's worst case scenario was different, but it all led to the same place, which was this market crash, and everything was going to kind of fall apart. So far that hasn't happened yet. I think at the same time, it's a little dangerous to look at 3 or 4 hours of trading activity right now and extrapolating that to what's going to be in the immediate future. We still could certainly see some volatility going forward. There's already questions about some of the mail-in ballots, how those have been handled and things like that. So it wouldn't shock me to see this drag out for a few more days and it to be somewhat contested. And I think that could maybe pump the brakes a little bit on this rally we've seen today. But I think overall, as we take a step back and we look, I think the environment, and I've said this a few times, I think the environment is going to be similar to what we've seen over the past 5 years, and that's going to be a government who's willing to step in if needed. And when I say if needed, specifically related to the COVID situation, but more importantly, you're probably going to have a Federal Reserve that is still standing, willing and able to provide liquidity to the market. And in that environment,
my question is, if I'm an HCM client, what does that mean to me? What's going to happen in my world that's either the same or different as a result of this. Realizing that it could change because every day we have new information. But as you're
Sure.
sitting here today, understanding all the things we've just talked about.
So I think, the thing that our clients would understand or should understand is that, we're we're still going to look for opportunities on the equity side. Will we lean as heavily into the value theme as we were before? I don't know. We might have to look and see what that breakdown looks like. We may look to add some more growth to the portfolio to balance that out a little bit. Could we have an environment where we, maybe add equity risk if bond yields get so low that we feel like there's no value there? Absolutely. And on the fixed income side, I think, we need to figure out ways to look for yield without, taking on too much risk and kind of balancing all of those things out. So I think, those are the things that I think, our clients will see going forward. And then, for those in the advance and defend, if situation changes, the facts change, the data changes, we will always be prepared to shift the allocation to a more defensive stance if we feel like that's the best option.
I think I know one of the things that comes up regularly in our investment committee meetings is that fixed income question. And as you were speaking there, you sort of said, what we might do in the fixed income realm if we don't see value there anymore. How close are we there to doing something different?
Well, I think that before the main worry was inflation. And when you have an inflationary environment, you don't want to own a lot of duration in your portfolio because that's going to affect your price, significantly. This outcome as it is now, I think changes the inflation expectations a little bit. So having some duration in your portfolio, specifically if you're going to increase equity risk, makes a lot of sense because they work as a good offset to each other. As we stand now, the benefit to owning treasury bonds, you're getting 75 basis points of income, which isn't a lot. But if you expect yields to continue to go lower from here, you could stand to make some money in the fixed income space. I mean, I think, a lot of people lose sight of the facts that I think, bonds are up pretty good this year. So, the price component of fixed income can be just as important as the income component when thinking about how it fits into a whole portfolio. But I think, we can also look to add more corporate debt, maybe add a little bit of yield there with a slight amount of credit risks. But I think the inflation trade or inflation assets that we've been kicking around, I don't know that those will be as imperative in the near term.
Okay. One of the things that we talked about, certainly a great deal when we did the call with Jeff Kleintop and followed up a little bit more, is the prospect for foreign securities as a class to begin to outperform U.S. securities as a class. Since that call, that really hasn't started to happen, and part of the challenge was with the expectation, at least a reasonable possibility, of the blue wave and the extensive stimulus. The dollar has managed to hold its own. It seems like without that, the sort of natural, although it may be slower, but the natural path of the dollar versus the basket of currencies it trades against is probably down. The natural course, at least, seems to me to be down. How would that affect this notion of a little more diversifying more broadly into foreign securities and actually seeing them do relatively well? I realize the underlying economies have a lot to do with it as well. I'm sort of just tackling this one piece.
Sure. So I think, let's take COVID completely out of the scenario. I know it's kind of a stretch to do that, but if we're just talking about the things that would be beneficial, so a weaker dollar versus foreign currencies would certainly act as a tailwind for international assets, and we haven't had that present over the past 5 years. The dollar's been very strong. The other thing I think that you can consider would be that President Biden would be how do I say this? I guess more willing to embrace trade policies from other countries. President Trump has been very outspoken, specifically against China, about trade practices and being very aggressive with tariffs and things like that. I don't know that a Biden presidency would consider any of those things. If depending on how you view it, I think is irrelevant. But if tariffs come back off the table, that's certainly going to be a benefit to a country like China. And with a big weighting in the emerging market index, could see emerging markets see a little bit of a bump as well. But again, this is a trade that's been ripe for the picking for years, and it still hasn't turned. So it's probably not going to happen overnight. But if we start to see some downside dollar momentum and some uptick in economic activity outside of the U.S., I could certainly see us start to rotate some money into the international side.
We're coming up on close to the end of our 30-minute period. I wanted to make one point because it sort of broadly affects everybody. I kind of ran through the litany of these blue wave unknowns that everyone was concerned about, and one of them was the potential for tax changes as early as 2021 that could have been made retroactive. Typically, that's not done. Typically, when those changes are they become effective when they're formally introduced. But they could have been made retroactive to 1/1, and we had a number of people concerned about what they should do about that. Thankfully, that seems to be off the table from a planning perspective. Now we are assuming, you hate to think of it in terms of going election to election, but we're assuming the tax rates will be stable at least through 2022. So the tax planning that we have already completed should be just fine, and anything going forward is not going to require major last-minute decisions going forward. The last thing, it looks like we have time for maybe one question.
I do have a question. This question, what election variables do we see as the most important in predicting market volatility, and how potent will a Biden administration be in implementing their plan without control of the Senate? Mike, you want to take the first part of that, and I'll take the second?
I was going to suggest the opposite. So
okay.
Have at it.
Fair enough. So election variables that we would say are the most important. I think if we can just get through these next few days without a slew of lawsuits, litigation, questions around how ballots were counted, I think that's going to be something that could cause a little bit of market volatility. But outside of that, I think everything seems pretty cut and dry, and we've kind of moved past anything that would be, I guess, feared, so to speak. I haven't seen any reports of any kind of social unrest or anything like that, so that's a great sign. So I think all things considered, we've moved through a lot of these variables that would cause significant volatility. And then, Mike, how potent do you think a Biden administration would be implementing their plan without control of the Senate?
So there's a perfect question of one that I'm completely ill-equipped to answer. But my takeaway is we've had a lot of experience at seeing sort of the mixed White House and Congress composure, and we sort of see how that works. So in terms of things that we saw on the campaign trail, probably not. There are certainly issues that are of a common interest. Everybody knows it. There were a lot of the political teasers coming into the election with regard to stimulus payments, for example, that I assume that Treasury Secretary Mnuchin and Speaker Pelosi will get together and get that taken care of. I mean, that work is essentially done already. Mitch McConnell has acknowledged that stimulus is necessary, so the Senate's not going to hold it up. He has indicated he has no particular interest in jumping on it right away. One of the risks that I've seen with regard to delaying the stimulus is that it will, and I guess this makes common sense, but it will cause a more protracted recovery. And so sort of like the silly putty recovery that gets stretched out. It'll eventually happen, but we won't get the pop that we would have had they been able to get this taken care of weeks ago or something along those lines.
Okay.
And of course, the political variables, there's always so many things changing that you don't really know. But so I would say the flip side then is, which I alluded to earlier, we've seen when chief executives are in this situation, the executive order becomes a powerful tool, as does how regulations are interpreted by the appropriate appointment of department heads and things of that nature. So they're certainly not neutered by the split control, but it will obviously keep us from having any of these things that really make a complete philosophical change in how we handle taxes and things of that nature.
Great, thanks.
I think that does it. Our time is up. Thanks everybody for tuning in. We will keep this process up to the extent that there is news and it's worthy of being reported. Otherwise, we will continue with our regular monthly calls, and you'll receive a notice about that when they get scheduled. Thanks, everybody. Bye-bye.